Hello, everyone, and welcome to the latest edition of LPL Market Signals. Jeff Bookbinder here with my friend and colleague, Dr. Jeffrey Roach. How are you today, Jeff?
Hey, doing very well. I'm glad you introduced me on the important disclosure slide. Is that like a sign or something that I need to start reading this?
You're the one that's more likely to say something that gets us in trouble. So I'm going to match your comments with that disclosure slide. Yes.
Very good.
You walked right into that one. So thanks for joining us. It is April 3rd, 2023, as we're recording this Monday afternoon. Here's our agenda for today. The usual market recap. S&P 500 has now risen 3 consecutive weeks. So we'll look at the S&P 500 chart. We'll also talk about the latest weekly market commentary that's available on LPL.com. And Jeff, you wrote most of it. It was a team effort between the Jeffs.
That's right. That's right.
It's who's right, the Fed or the market?
We'll dissect that in the coming moments.
That we will. An interesting discussion, no doubt. I suspect you're going to talk about whether the Fed's going to cut rates this year or not when we get there, but I'll just leave that hanging. Next, April showers may not be in the forecast. So we'll just look at a couple of seasonality studies to make the case that maybe this little run we've had has more legs. And then finally, week ahead jobs report on Friday when the market will be closed for the holiday, and then the ISM. I think probably those are the two potentially most impactful or market moving reports. But if I miss one, Jeff, you will tell me. So starting with the market recap, equities globally, the first thing that you'll notice here is what a strong week it was, right? S&P 500 up 3.5% for the week, despite ongoing concerns about bank stress. We also had a strong week outside the U.S., particularly in Europe. You can see the the Euro Stoxx 600 up over 4%. Jeff, I'll go to you on this. Europe's market continues to do really, really well. A little bit of this is the dollar, but it's not just currency translation. Have we gotten economic news out of Europe that justifies this strength? Is there something going on under the surface, do you think?
Well, I think some of the numbers may be skewed a little bit with the base effects. So, relative to where the European markets were, say, 2, 3, 4 months ago, relative to the U.S. I think one of the things, though, you look at Germany, France, you look at Spain, more developed side of Europe, and some things have been surprising to the upside, and perhaps we're not going to have that nasty recession that seemed to look all but inevitable when we were, looking and analyzing things just, going into the Q4 of last year. So I think there's perhaps some stability, at least starting to emerge out of Europe. So that's good news.
Yeah, it's debatable whether the U.S. market priced in recession, but I think it's less debatable that Europe did. Maybe they haven't had one yet, but they've certainly braced for it over there, and that became consensus certainly late last year. And then falling natural gas prices have allowed that economy to hang in there really well. I guess maybe had less strength in Asia. Certainly, ongoing U.S.-China tensions that we're going to have to live with for quite some time. Turning over to the sectors, Jeff, we had some really big gains in some of the top sectors last week. 6% plus in energy. You'll see on the next slide that oil was up about 9% last week and is adding quite a bit to those gains today. As we're recording this, last check, I think crude was up about 6% on the news that OPEC Plus was cutting production unexpectedly. So, energy led, but we had, pretty solid gains from consumer discretionary, from materials, from real estate. Tech was a market performer, but still up, over 3%. So really across the board strength here. I think the only thing that really jumps out as an outlier is if you look at the 1 month column, you see what's happened to financials, right? Down 9.6% over the last month, clearly an outlier.
Yeah, the one thing I'd add too, Jeff, is which is impressive when you think of what markets were communicating to us prior to some of the challenges on the West Coast. And that is, you go to the 6-month column right there in the far right, and you see the underperformance on financials being in, high single digits, but pretty much a lot of these other sectors were in double digits. So some of the challenges that the financial services industry has had, independent of, the Silicon Valley challenge, clearly I think this communicates that point that there's been some challenges in financials even before this mini crisis, if you will.
Yeah, absolutely. I think it's worth pointing out that even though tech was a market performer last week, the mega cap techs have been supporting this market really all year. I did the math, and of the 7.5% gain in the S&P 500 during Q1, that's total return, over 6 points was from the mega cap tech names, right? We're talking about, Facebook, Google, Apple, Microsoft, et cetera. I threw Tesla in there. We'll call that a mega cap tech name. You just need the top 8 contributors. They're all tech or tech adjacent. And that was pretty much the entire gain in the first quarter. Now, our technical strategist, Adam Turnquist, tells us that the breadth is okay, right? But certainly the leadership has been in mega cap tech land. So turning to fixed income and commodities, we were just having a discussion at our investment committee meeting about how interest rates or bonds are tougher competition for equities these days. And so, if you just look at the 1-month column, the broad bond market benchmark's up 2.5%, right? So even though the stock market's done better, if you can get that kind of return in a short period of time from the bond market, it makes the decision between stocks and bonds a little bit tougher. So I mentioned oil. You don't see oil specifically on this table, but energy up 4% last week. That was, oil doing quite a bit better and natural gas doing worse. It's been a sharp bounce back. Crude oil is over $80 at last check, and certainly has, people wondering if we're going to get a little bit of an inflation pickup, right? And this is where we get into your world, Jeff, as our chief economist. Are we going to get a little bit of inflation if oil keeps moving higher? That's potentially going to tip the Fed maybe toward an extra rate hike?
Well, I think to answer the question, I got to set the stage just a little bit. And that is, you think about, energy, and you think what we say is good for an energy sector, a good run, i.e. prices going up, might truly be bad when you're thinking about another part of the broader equation, right? High energy prices, greater risks of a slowdown in terms of, general activity. So specific to your question, Jeff, about the oil price question, so we had, a spike in prices. We actually wrote about this for some of our client directed communications. And that is, you think about where we are as a services oriented economy now today, the modern economy, relative to where we were in previous cycles, previous decades, where we were a little more manufacturing oriented, or at least that was a larger share of the overall economy. So you think, okay, eventually, if in the services oriented economy, yes, higher energy prices will still be a problem, but it takes a little bit more time for it to pass through, right? So you're not thinking of the more direct effects and of costs of manufacturing. Now, granted, if you break it down into sectors, certainly the transportation sector is going to feel a little bit more the pinch of higher prices there in the crude oil markets, but it's very possible that this will be somewhat short-lived. OPEC Plus hiked. I'm sorry, they responded to the slowdown in the macro environment by cutting production, hence the spike in prices. But I think it's just an early move toward what we're all forecasting, and that is a global slowdown. So that forecast of a global slowdown, I think, is really, that's going to come a little bit later. I don't know if it's going to cause that much of a problem in the very near term when Fed meets again, inflation pressures still elevated. It's mostly in that services sector, core services, ex housing, that we'll actually talk about in a few slides from now.
Absolutely. Yeah. Inflation is certainly part of our presentation today. So let's look at the S&P 500 here. We had a nice breakout above the 50-day moving average. You can see that I priced this a few hours ago, so it's off, might be off a little bit, but generally speaking, as you break above these moving averages, it tends to be positive technical development. And then, I'm also starting to see the slope of these averages tick a little higher. That's certainly positive. So, from just a pure technical perspective, we still like stocks here, and we're still, recommending overweights to equities relative to target in our strategic and tactical asset allocation committee. I will say though that, breadth, we're getting some questions about breadth because the media is talking about how just, 6 or 8 stocks are driving the market. That's true, but that doesn't mean that, the rest of the stocks aren't participating. They're just not as big a drivers, but collectively, the majority of the S&P 500 is, actually above its 50 and 200-day moving averages now. So let's turn to the main topic for today, Jeff. Who's right? The Fed of the market. This is the weekly market commentary for this week on LPL.com. You used a few charts here, so I'll just turn it over to you to walk through these.
Yeah. So thinking about where we are in the cycle, we really could drill into that chart you just showed us just a few moments ago with the S&P, and that is from October, those lows of October, every kind of mini cycle downturn in equity prices, you're getting a little bit higher lows, right? The bottoms are getting a little bit better and better. So you're seeing clearly the 50 and 200-day moving averages moving up. And the point, I think, in all that is to say that, we're expecting the economy to slow further from here. Bottom line is, because of that economic slowdown, we expect inflation to be much better, more, I think, more conducive for, the stock market to respond by that. And one of the pieces of the pie that you want to kind of put together here, thinking about where the macro environment is, and that is, look at the labor market. The labor market is going to be, and always has been, a key component for how the NBER, the National Bureau of Economic Research, looks at business cycles. Clearly, the labor market is one of the driving forces for, growth in real disposable income and purchasing power, ability to spend on the consumer side. And I think the key that's really kind of emerging with this chart that I show you here, and this is from the Job Openings and Labor Turnover Survey, so that we call it the JOLTS report. We shorten that up for obvious reasons, not having to say the whole phrase. And the JOLTS report basically reveals to us that this is, right now in this stage of 2023, moving out of Q1, going into Q2 now, firms are now responding, cutting workers, not necessarily just for cost-cutting reasons. That's your orange line. They've been doing that for a long time in this recent post-pandemic economy. But you see the blue line there, and that's basically indicating that firms are saying the reason why we're laying off people is because we're actually seeing a slowdown in demand. And that's, in some ways, this is the kind of thing you want to see for an economy that should expect lower and decelerating rates of inflation. So I'm building the case basically to say, hey, in the overall theme, markets, I think, have it right in that the Fed will cut by the end of the year because the economy is slowing and hence inflation is slowing. So we can go to the next slide. That's just kind of the big takeaway. For those that want to drill in a little bit deeper, you can go to LPL.com, the main page there, and under the press releases, there's a weekly market commentary link. And so you can read all the commentary here. But here in the very, very near term, and this is kind of the challenge, Jeff, that policymakers are working through, and that is, we're slowing down as an economy, Yet the services side, the sticky side of inflation still seems to be elevated and persisting and frustrating, the markets and the Fed looking at, how the inflation rates are matter for the what we call core services ex housing. So you think about financial services, think about transportation services. We just referenced that as it relates to energy prices. Well, the point is that one of the reasons why services inflation is staying elevated is because there's still this retooling and recalibrating going on between how consumers spend their money. Pandemic, it was this shift away from services, a shift toward goods. We're all going on our Amazon apps and, buying stuff. Well, we're finally seeing maybe, this emerging behavioral shift of saying, okay, we want less stuff. We want more experiences though. And hence that's where you're seeing this upward bid on prices for the services side of the economy, because everybody's still clamoring to make up for time lost. We've bought our things. Now we want our experiences. So this is it. We're getting a little bit closer to pre-pandemic norms, but it's going to be a little frustrating from an inflation standpoint, right? If everybody's clamoring for the cruise, or everybody's going to do their trip to the amusement parks, you can keep with more and more analogies. The point is that price action will respond by saying, all right, we got to allocate these scarce resources. Hence, you'll see prices rising as more and more people are clamoring for that and releasing some of that pent up demand. That's going to show up for a little bit longer, but I think we're at the tail end of seeing those core services ex housing inflation being so elevated. So go to the next slide, and that's basically showing you that in some ways the Fed is getting tighter financial conditions, but just not the way that they expected it to get it, right? The Fed's saying, hey, we're hiking rates, therefore we're going to see tighter conditions, and therefore we're going to see inflation cool. And it hadn't been happening, and it's been frustrating many portions of the markets. Well, we have a mini banking crisis, certainly not widespread, but it was enough of a challenge to actually tighten financial conditions in a way that perhaps might actually finally cool the inflation component. Again, not as the Fed expected. What this chart is basically saying, the shock to the system that we had in the fixed income markets a couple weeks ago was really quite historic, even when you compare it to the great financial crisis. So that's all this chart is basically revealing to you, is basically saying, you think about this week to week change in 2 years, 2-year treasuries. And, we clearly remember those days, those that were in the business back in the day, in the 2008 kind of great financial crisis era, where there was a lot of volatility, a lot of uncertainty, partially because of fundamental cracks in the system. Well, you look at what happened just in the last 2 weeks. By the way, you see that downward spike there. As of today, that has recovered. So don't be misled by this graph. You just can't see the detail of the daily detail here. But you can see that relative to even previous periods of stress, the banking crisis in this very focused area of the financial services sector, you saw a pretty extreme move in yields, and that clearly denotes some kind of cause for concern, cause for tightening conditions. When we say tightening conditions, by the way, Jeff, make sure our audience understands this. It's very basic in the sense that when you see tighter conditions, that just translates to a less easy money, as it were, and a most likely response by consumers to kind of pull back, retrench, be a little bit more conservative with their spending, and thereby again another I think, another factor to say that inflation is definitely set to cool. So before we leave this, again, kind of a quick shout out to going to the LPL.com website for more detail on this. This is a little bit of a teaser, but I think, where do you put your stake in the sand? The point is, by the end of the year, inflation is going to be below 4%. It's going to be, in the mid, maybe to upper threes. Inflation's cooling. The economy's cooling. Certainly going to be good news for markets when we can finally see convincing data come out of that. And so hence, going back to the question at the outset of this little section, where we're saying, okay, who's right? Is the Fed right, saying they're going to keep hiking and they're going to keep those rates elevated? Or is the market right? Market's expecting the Fed to cut at least a couple times by the end of this year, of 2023. And who's right? My vote, I think the markets are right. And I think, as I laid the base case here for a slowdown in inflation to cool, I think markets are right. And the Fed's dot plot is perhaps a little bit, will become a little bit stale, as it were, with that forecast. So there you have it in terms of, where we think, equities might, again, they certainly respond favorably when the Fed finally communicates and, arrives at the end of their rate hiking campaign.
Yeah, stocks tend to like the end of a Fed rate hiking campaign, and they also tend to like lower interest rate volatility. So we think we're going to get both of those things over the next several months, which keeps us, in the bull camp. We'll call it cautiously constructive bulls, not table pounding bulls by any stretch, but we still like stocks here. So we're putting your voice to the test here, Jeff. I know you had to talk a lot last week, but keep going and explain what our viewers should be looking at here with regard to this inflation heat map.
Yeah, that's exactly right. And again, a good point, Jeff. You kind of added to the takeaway here. Stocks tend to respond favorably to the end of a rate hiking campaign. And I guess the corollary to that is the markets definitely respond favorably when there's lower volatility, interest rate volatility. So clearly, a good thing. And I think, we've kind of hinted at this kind of even more specified line item in inflation, this core services ex housing component that's on the bottom line there. And you can see just a real simple heat map. If you're reading from left to right, what you want to see is what we're seeing in the first, 3 or 4 or 5 columns or rows here, right? You see dark red in June 22, and you're eventually getting to green in February 23. That's what everybody's wanting. And of course, you go farther down in this little matrix and you realize it's not really showing up in every line item. I think what it does visually is it explains, to our audience here that this is exactly why we talk about how inflation components of rent and housing tends to lag the rest of the economy. This is the case in point, right? You go to the middle of the chart, the rent of primary residence and owner's equivalent rent there. We're going from green to red. Everything else is red to green. It's just because that tends to lag. This is no surprise. This actually does this in previous cycles. So it's not one of those things where we want to say, oh, this time's different. This is just normal, and it takes time for the impact of new leases and new rental agreements to kind of start showing up a little bit weaker. And we do expect, certainly by the summertime, that this entire chart will be a lot more green, even as you're reading from left to right.
So my takeaway from this is to not get too frustrated if we see, kind of a leveling off of the inflation readings, the year-over-year readings, right? Kind of a plateau, but eventually the real-time data we're seeing now will flow through, and we'll get that kind of fall dip to get to that kind of mid-threes number that you alluded to, Jeff. So
yep.
Better inflation days ahead. It's not going to be a straight line down because of these lags. So still a positive story for equities. Speaking of positive stories for equities, let's talk a little seasonality. this is a little more than seasonality, I guess, when I get to the next chart. But this is the kind of the basic seasonal chart, Jeff, which just shows, you know, how on average the S&P 500 is done in each calendar month. And you see here the batting average for April, 71% over this really long time horizon. And then the average gains 1.5%. Those rank second, well, second or third, depending on which metric you use. But the point is, April is a very good seasonal month. So there's certainly we would argue, better than 50-50 chance that, we'll be at a double-digit return by the end of April. So this next slide, because we're already up, 8%, give or take right now. So this is even more powerful. It's a simple study, but I'll set it up. If you look at down years for stocks, and we had one last year, you can see here 2023, the S&P 500 was down 19%. Right after down years, if you have an up first quarter, then you tend to see a gain in April, and you tend to see a really solid gain in the subsequent 9 months. So, these numbers are really impressive. Now, these studies, you always give the disclaimer, the sample size isn't huge, right? And this could be the first time after 10 that this doesn't work. But we would say more likely than not, this market will go higher between now and the end of the year. And this is at least one piece of evidence that's likely to happen. So once you get that up first quarter, we got that this first quarter, right? Up over 7%. The average gain for the rest of the year is 16%, and you're up every single time. So, there are a lot of studies like this, Jeff, that tell us stocks are going higher, but this is about as compelling of a study as I think I've seen. Maybe the other one that's really compelling right now is the midterm election year lows tend to be followed by 30% gains. And we've done about half that already. The batting average for 1 year gains off of midterm year lows, or even off of the midterm election itself, is pretty much 100%. So those are compelling studies too. But boy, it's hard to bet against this, even though there are a lot of bears out there. What do you think?
Well, it's interesting when you think about the intense challenges in some of those years. Think about 2019, right? The prior calendar year, 2018 was negative, right? As you're showing, 2019 is positive. 2019 was a year where the economy was slowing. The Fed actually cut rates, right? And we had challenges on, trade wars and what we were doing, with some of the tariff activity. And so I think that's kind of compelling when you think, comparing those previous years with where we are now. We certainly have a lot of headwinds, right? Russia, Ukraine is still a challenge. You got some other headwinds, and 91, by the way, another example where there's some slowdown in growth activity, maybe coming out of a recession. So it's still, when you put the numbers in its macroeconomic context, you can still kind of make the point that this is a legit way of looking at some of the numbers and some of the upsides, even as we look at 2023 going into Q2 and on forward.
Yeah, we were down 25% at the lows last year, peak to trough. So you could make the case that priced in a mild recession, and we got something close to that maybe last year, and now we're in the recovery phase. That is certainly a reasonable scenario. So we don't want to dismiss the risks here. And a lot of people are pointing out that the S&P 500 bottoms typically during a recession, right? And then we might get a recession in the next 6 to 12 months. So therefore, maybe you have to go back to the October lows. Well, not so sure. Not so sure. Maybe maybe the whatever we were going to get that looked like a recession, or maybe it wasn't a recession, whatever it was, maybe we got it already, and we're just going to muddle through and kind of bump along here.
Yeah.
I think that makes sense as a scenario. It's not a tail scenario.
Right.
I think that's probably as likely as the the downside scenario where we just have a recession and stocks drop 25-30% from here, which is the historical average drop in a recession.
And that's what we were talking about in our earlier meeting here as a committee. Perhaps markets got that head fake, 2 consecutive quarters negative growth in 2022, not a recession, but the head fake, as I was calling it. And, those October lows were pricing that worst case scenario. And perhaps we might have that slowdown, might have that recession, but it's not the worst case scenario that was already priced in October. So just to underscore the comments you just made, Jeff.
Yep, absolutely. We got a wall of worry, we're climbing. So this week it's payrolls week. Even though the market's closed on Friday, we're getting that data point, Jeff. That's probably the biggest number of the week. I mean, we already got the ISM. It was good for the folks worried about inflation, but it was not good for those folks looking for growth. What are your takeaways from the ISM, and then what should we watch for in the jobs data this week?
Yeah, so I think if you could get what you want, we would want this very predictable slowdown. It's almost like the predictable recession, as it were. So the manufacturing report on business was below 50. Anything below 50 just means that it's contracting relative to the previous month. I think it's important to remind the listeners on that. That's the whole point of that 50 mark, the line in the sand. And so, the decline in factory activity is the lowest since May 2020. Again, we're not a manufacturing economy. We're a services-oriented economy. But this does help, I think, build the case that, the economy is slowing, somewhat measured, as it were. And then we'll get the services component on that report on business on the 5th. We have it highlighted there, ISM services. It's a report on business, but it's all about Friday's job numbers. So what we're wishing for, what we're hoping for is, a measured slowdown, a measured decline in the job market. You don't want surprises, right? No one likes surprises, including markets. They don't like surprises. And so consensus is still pretty hot, above 200,000 expected for the month of March. I'm a little bit on the low end of that. I think it's going to be even sub 200. We're talking about a number of survey data that suggests the job activity, the hiring activity is slowing and cooling. So that's exactly what we want to see. We want to see this measured slowdown, but that's going to be the big one. I think there's still a lot of concern on wage pressure, right? That's adding some of the upside on inflation. So if you see wages start to cool down, that's going to cool down your real disposable income from the consumer base. And so those are the numbers to look for. And we'll see how that happens. But yeah, you're right. Markets are mostly equity markets are closed on Friday, Good Friday there, but still have economic data. Still work to be done. Data coming out.
Interesting that you think payrolls might come in a little bit light, because that has not been the trend, right?
We have been surprised several months in a row.
Yes, and I think payrolls have only missed maybe once or twice in the last year. So it's been a pretty steady string of upside surprises. So I'm not challenging on that, but I that would be a change in what maybe markets and pundits are used to seeing. So we'll see. Still 50-50 on a Fed rate cut, or rate hike rather, in May, roughly, based on the Fed funds futures, maybe a little bit more in the pro cut camp. But if we get a soft payroll number, you're certainly going to see that go back down to 50-50 or maybe even less. So thanks for walking us through the data for this week, Jeff. And thanks for joining. Certainly we had a lot of economic content, so it was great to have you on. So
as always.
Thank you. Thanks, Jeff. So thanks to all our listeners for joining us again on another Market Signals podcast. Just always fun to do this. Everybody join us next week for another edition. We will see you then. Have a great day, everybody.
Take care.